Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is January 17th, 2012, and my guest is Eugene Fama, the Robert R. McCormick Distinguished Service Professor of Finance at the Booth School of Business at the University of Chicago. Gene, welcome to EconTalk.
Thank you. My pleasure.
Your impact on the field of finance has been immense, particularly in a whole bunch of areas, but one that stands out is the efficient markets hypothesis. I'd like you to sketch out the evolution of that idea in the field, how it was understood initially, and how it has changed over time.
How much time do you have?
Well, 4 or 5 hours, but let's try to keep it to under 10 minutes for this first question, if you can.
Okay. Well, I'll go back to the beginning, at least the way Harry Roberts tells it. Holbrook, working in the 30s, started to become interested in whether speculative prices moved randomly. So he was mostly an agricultural economist, so he was looking at agricultural commodities. And he took a series of random numbers, accumulated them, and brought them to his faculty at Stanford in the faculty lounge, I guess, showed them to them, and they agreed they were agricultural theories. So he thought from that maybe a random walk kind of model would work pretty well for agricultural prices of other commodities. So, but then there was a big gap from there to like the end of the 50s. And what opened things up was the coming of computers, which made computations much easier. And the most readily available data was stock price data. So basically, statisticians, econometricians took the data and started doing calculations on it. And they were calculating the autocorrelations, which are estimates of how predictable returns are based on past returns. And then they stopped and said, economists got into the mix and said, okay, how would we expect prices to behave if they were set based on all available information, which is basically the efficient markets hypothesis, but it wasn't stated in those terms at that time. So they kind of said, okay, I think there should be a random walk, which was pulled out of the air. Hypothesis pulled out of the air.
And what is that, when you say it's a random walk, explain what that means.
That means that successive changes are independent of one another. It also means they have identical distributions, but that part's not important.
Right.
It's basically the independence part that's important. So it basically means that you can't predict future returns based on past returns.
And yesterday doesn't tell you anything about tomorrow.
And right, returns from day to day or month to month are basically independent of past returns. Now that was a very extreme hypothesis. So let me give you an example. You wouldn't say that about tomatoes, for example. Tomatoes are going to be cheaper in August than they are in January, for the most part, because there's a seasonal in tomatoes. And that has to do with supply and demand, mostly supply of tomatoes. But there's a similar thing operating in prices of stocks, bonds, whatever. So basically there's an expected return component, what people require in order to hold these securities. And there's no reason that has to be independent through time. There's no reason why that's not predictable, or why it doesn't go, why it isn't. For example, there's lots of evidence that it is higher on stocks during recessions and lower during good times. So there can be predictability in returns that's consistent with an efficient market. Now, what people didn't understand in the beginning, am I getting too technical here?
Nope, you're doing great. Keep going.
Okay, what people didn't understand in the beginning was that propositions about how prices should behave had to be joined to a statement about how you think they ought to behave. So In other words, what you need is some statement of what we call a market equilibrium. What is the risk-return model that you have in mind underlying the behavior of prices and return? So, for example, stocks are very risky. They require a higher expected return than bonds, and you have to take that into account in the test. So there is this joint, what I call the joint hypothesis problem, which is basically what I added to the mix, but it's kind of an important part of it. It says whenever you're testing market efficiency, you're jointly testing efficiency with some story about risk and return. And the two are joined at the hip. You can't separate them. So people infer from that, it means that market efficiency basically is not testable on its own, and that's true. It's not testable on its own, but the reverse is also true. Risk-return models aren't testable without market efficiency. Most risk-return models assume that markets are efficient. Very few exceptions.
And so when we say markets are efficient, what do you mean by that?
What you mean is that prices at any point in time reflect all available information.
Now, that idea, which, there's, what's the distinction between the weak form and the strong form that people talk about?
Those are words that I used in 1970 that I came to regret. But
because
I was trying to categorize the various tests that were done. So I call weak form tests that only use past prices and returns to predict future prices and returns. Then I call semi-strong form tests that use other kinds of public information to predict returns, like an earnings announcement or something like that. And then I call strong form tests that look at all available information. And those are basically tests of, if you look at groups of investment managers, when you look at the returns that they generate, you're basically looking at all the information they had to generate to pick securities, and what's the evidence that they had information that isn't in prices. So that's what I call the strong form.
And empirically, where do we stand today, do you believe, in what has been established about those various hypotheses?
Well, believe it or not, the weak form one has been the one that's been subject to the most, what people call anomalies in finance. In other words, things that are inconsistent with either market efficiency or some model of risk and return. So the big one at the moment is what people call momentum, that prices seem to move in the same direction for short periods of time. So the winners of last year tend to be winners for a few more months, and the losers tend to be losers for a few months. In the strong form tests, Ken French and I just published a paper called Luck versus Skill in Mutual Fund Performance, which basically looks at the performance of the whole mutual fund industry in aggregate, all together, and fund by fund, and try to distinguish to what extent returns are due to luck versus skill. And the evidence basically says you've got skill in the extremes, but you've got skill in both extremes.
Right.
Which is, that's something people have trouble accepting, but it comes down to a simple proposition, which is that active management trying to pick stocks has to be a zero-sum game before cost, because the winners have to win at the expense of losers. And that's a kind of a difficult concept, but it shows up when you look at the cross-section of mutual fund returns. In other words, the returns for all funds over very long periods of time. What you find is, if you give them back all of their costs, there are people in the left tail that look too extreme, and there are people in the right tail that look too extreme. And the right tail and left tail basically offset each other. If you look at the industry as a whole, the active management industry basically holds the market portfolio.
Right. So, but is that...
Now that's all before cost. If you look at returns to investors, then there's no evidence that anybody surely has information sufficient to cover their costs.
which says that for an individual investing, certainly someone like me,
right,
that is, who doesn't spend any time or very much time at all looking at, in my case, no time, but let's suppose I spend a little time trying to look at what would be a good investment. The implication is to go with index mutual funds because they can't, actively managed funds can't outperform.
Well, no, it's more subtle than that.
Go ahead.
What's more subtle about it is even if you spend time, you're unlikely to be able to pick the funds that are in good.
Right.
Because so much of what happens is due to chance.
So for me, the lesson is buy index mutual funds because the transaction costs of those are the smallest.
Yeah.
And since very few actively managed funds can generate returns with any expectation other than chance to overcome those higher costs, I can make more money with an index fund.
Now, it's very counterintuitive because we looked at the whole history of every fund's returns. And if you sort them, naturally the ones in the right tail are really extreme.
There's some great ones, yeah.
They beat their benchmarks by 3 to 6% a year. Nevertheless, only 3% of them do about as well as you would expect by chance. Now, what's subtle there is that by chance, with 3,000 plus funds, you expect lots of them to do extremely well over their whole lifetime.
Sure.
So these are the people that books get written about.
Because they look smart.
But the evidence basically says there's a pretty good chance they were just lucky. And they had sustained periods of luck, which you expect in a big sample of funds.
Right. Of course, they don't see it that way.
No, of course not.
A friend of mine who's a hedge fund manager, before I made this call, I asked him what he would ask you. And he said, well, his assessment is that, efficient markets explain some tiny proportion of volatility of stock prices, but there's still plenty of opportunity for a person to make money before markets adjust. And of course, in doing so, make that adjustment actually happen and bring markets to equilibrium. Somebody has to provide the information or act on the information that is at least public and certainly maybe semi-public. What's your reaction to that comment?
That's the standard comment from an active manager. It's not true. Merton Miller always liked to emphasize that you could have full adjustment to information without trading. If all the information were available at very low cost, prices could adjust without any trading actually taking place. Just bid-ask prices change. So it's not true that somebody has to do it. But the issue really is, this goes back to a famous paper by Grossman and Stiglitz. The issue really is, what is the cost of the information? And I have a very simple model in mind. In my model, information that's available is available at very low cost, and then the cost function gets very steep. Basically goes off to infinity very quickly.
And therefore?
And therefore, prices are very efficient because the information that's available is costless.
But what's the implication of that steep incline? It's just that takes that information's not very.
It doesn't pay to try to take advantage of additional information.
It's not very valuable.
Beyond the stuff it's very valuable. If you were able to perfectly predict the future, of course, that would be very valuable. But you can't.
So
it's infinitely costly.
So your assessment that you just gave me of the state of our knowledge of this area, I would say, is that remains what it has been for some time, which is at the individual level, certainly there's no return to all prices. Prices reflect all publicly available information for practical purposes for an individual investor.
For an individual investor and for an institutional investor.
Correct. So how many people, what proportion of the economics and finance areas do you think agree with that?
Finance has developed quite a lot in the last 50 years that I've been in it. So I would say the people who do asset pricing, which is, risk and portfolio theory, risk and return, those people are pretty much think markets are pretty efficient. If you go to the people in other areas who aren't so familiar with the evidence and asset pricing, well, then there's more skepticism. But I attribute that to the fact that the finance, like other areas of economics, has become more specialized, and people just can't know all the stuff that's available.
Sure. A lot of people have viewed the current crisis in.
Well, let me stop there too. There's an incredible demand for market inefficiency.
Explain.
The whole investment management business is based on the proposition that the market's not efficient.
Sure.
I say to my students, you take my course, if you really believe what I say and you go out and recruit and tell people you think markets are efficient, you'll never get a job.
Yeah, it's true. So there's a certain bias, you're saying, towards how people assess the evidence.
There's a bias. The bias is based on, among investment practitioners, professional money managers, the bias comes from the fact that they make more money from portraying themselves as active managers.
Sure. That's true in macroeconomics as well. We'll get to that, I hope, a little later in the conversation. But I was going to ask you about the current crisis, and I
have some unusual views on that.
Yeah, I know. I want to hear them. So the standard, I'd say that the mainstream view, and I recently saw a survey I'll put a link up to that said it was an esteemed panel of economists. You weren't on it, but it was still esteemed, both in finance and outside of finance. And they asked them whether prices reflected information, and there was near unanimity. Some strongly agreed, some just agreed. But there was also near unanimity that the housing market had been a bubble, and had
the nasty B word, yeah.
Yeah, was showing some form of what we might call irrationality.
Well, okay, so I have strong feelings about that. I get mad about the word bubble.
Why?
Because I think people see bubbles with 20/20 hindsight. I don't think the term has lost its meaning. It used to mean something that had a more or less predictable ending. But now people use it to mean a big swing in prices, that after the fact is wrong. Well, all price changes after the fact are wrong. Because new information comes out that makes what people thought 2 minutes ago wrong 2 minutes later. And I think that's the housing bubble. If you think there was a housing bubble, then if you could have predicted it, that would be fine. But the reality is, all markets did the same thing at the same time. So you have to really face the fact that if you think there was a housing bubble, there was a stock price bubble, there was a corporate bond bubble, there was a commodities bubble. Are economists really willing to live with a world where there are bubbles in everything at the same time?
And your explanation then of that phenomenon?
My explanation of it is we had a big recession. I think you can explain almost everything just by saying we had a big recession. A really big recession.
And why do you think we had a really big recession?
Well, I've heard some of your podcasts. I'm with you. I don't think macroeconomists have ever been good at knowing why we have recessions. We still don't understand the Great Depression.
True. Although Ben Bernanke would argue, and Milton Friedman would argue, and he did before he passed away, that monetary policy is a huge part of it.
Well, let me respond. I had this discussion with Milton actually, and what I pointed out was from their own data, they show that there were massive free reserves throughout the Great Depression. And my point is, you can't force people to hold demand deposits or to make loans or to demand loans.
Well, you can, but it's not very productive. But
it's not very productive. That M1, M2, those things are basically endogenous.
Yeah, I have the same feeling. What did
the
Milton
only thing that's sort of exogenous is the monetary base.
What did Milton say to that?
All arguments with Milton were interesting. Even when you won, you thought you lost.
Yeah, I know. I had plenty of those. So are you saying that that's analogous to our current situation?
Oh, no. What I'm saying is that, for example, people want to blame the recession on the housing sector crashing and subprime mortgages. But so if you're an economist and you think about that, you have to be saying that there was some misallocations across markets, that margins weren't being equated across markets. That's pretty hard to accept because people are acting in all markets. They're working in all markets. It's a pretty tough one to swallow.
Well, a lot of people swallow it. Here's their version. They say things like, there are these things called animal spirits that you can't measure, but that doesn't mean they're not real. That people get all excited about a particular asset class. In this case, it was housing. And as those prices start to rise, it becomes rational to speculate that it will continue to rise. And as that happens, as you would admit, people are making money along the way. And then they don't. They stop making money and the prices collapse. And this happens from time to time because of irrational exuberance. And that's just an aspect of capitalism. That's the standard counterpoint.
Okay, but it wasn't just housing. That was my point when we started. The same thing was going on in all asset markets.
Well, the timing isn't quite identical for all asset markets, right? The stock market, the housing market starts to collapse, I think, around mid-2006.
Oh, it stops rising, right.
And then it begins a steady decline.
That decline was nothing compared to the stock decline.
When did that happen?
I don't know the exact timing.
It's not around then. It's later, right?
The onset of the recession caused the collapse of the stock market. I mean, it was the recession and the collapse of the stock market, the corporate bond market, all of that basically coincides. But that also coincides with the collapse of the securitized bond market.
The mortgage.
Subprime mortgages and all of that.
Well, that happens through 07, 08. I guess that there is some parallel.
Yeah.
So you're going to reverse causation.
I don't know. See, I'm not saying I know. What I'm saying is I can tell the whole story just based on the recession. And I don't think you can come up with evidence that contradicts that. But I'm not saying I know I'm right. I don't know. I'm just saying people read the evidence through a narrow lens.
Yes, they do. Confirmation bias, all kinds of other,
Well, and the rhetoric then acquires a life of its own. So there are books written that basically all say the same thing about the crisis.
And you're arguing that they've essentially cherry-picked the data.
Well, they just look at pieces of the data, and the fact that the housing market collapsed is taken to be the cause, but the housing market could collapse for other reasons. People don't just decide that prices aren't high anymore. There has to be supply and demand somewhere in the background.
Well, we did have people holding second and third homes who didn't have the income and capability of repaying even a first loan.
Sure. Standards were relaxed.
Yep.
But then you have to look on the supply side of the lending side. The people lending to these people had the information.
Yeah, they knew it.
They knew it.
No, there's no doubt that they were not. I don't think they were fooled. They were not overly optimistic about the value of those loans. They were willing to do that because they could sell them. The puzzle then is why.
But that's just right. The puzzle is why were they able to sell them?
Correct. My claim is that the people who bought them did it with largely borrowed money.
No, that's not true. These were bought by people all over the world.
Correct.
Not with borrowed money. Remember now, savings has to equal lending always. I mean, for everybody that's short bonds, is a borrower, somebody is on the other side. They're long.
Yeah.
The net amount of leverage in the world is always zero.
That's true.
So you can't tell a story based on leverage.
So what's your story? I have to think that through. It's undeniably true, but I'm not going to argue at that point. But I want to. So, what's your explanation of why people bought these things?
I have no explanation. I'd say the market crashes because there's a big recession or even a minor depression, if you like. So remember now, all the people buying these subprime mortgages all over the world, they were the ones basically making the loans in the end. They were sophisticated investors. They weren't you
Yes,
and
they
I.
were.
They were sophisticated investors.
Most of them, many of them.
Institutions, big banks all over the world. So they thought these things were appropriately priced. They might have been at that time, but they weren't exposed.
So you're not going to allow me to make the claim that the incentives they faced to worry about how appropriately they were priced were distorted?
Incentives to make money are always there.
Correct.
The question is whether the market lets you make money or not. So these people that wanted to securitize all these mortgages, they could have failed at any time in the process. And they would have failed big time because in order to do these things, you have to initially finance them yourself. So when the investment bankers were bringing out these securitized mortgages and other kinds of securitized assets, they initially held them. And they held them afterwards, too.
They held many of them.
Yeah. Well, initially they held them all. Because they're bundling them together. They have to come up with the capital and then they can sell them. So they could have failed right at that point because the market says, forget it, we're not paying you par value for these things.
But when they did fail, which they fundamentally did,
right,
because at least for them, even though the world wasn't leveraged, they were leveraged.
Sure.
They should have gone out of business, but they did not.
Exactly.
But they did not, most of them.
That's awful. That's the worst consequence of this whole episode.
So my argument, my narrative is that the anticipation of that distorted their decision making. Do you think?
Sure, but that doesn't get you past that doesn't satisfy what goes on the demand side. Doesn't address that.
Why?
Because the people on the demand side have to buy these things.
Well, the people who were buying them and selling them were fundamentally the same people, right?
Okay, so if greed causes me to put out securities that I know are no good, why would I hold them?
Because I can hold them at a very low cost. I have uncertainty. I don't know what's going to happen. There's an upside. There's a downside.
There's only a low cost if you know you're going to get bailed out.
Say again?
There's a low cost if you know you're going to get bailed out. There, you and I agree.
Right. So, but you don't know that. There's a probability.
Right.
My argument is it dulls your senses. It doesn't. You don't.
Well, I think it does. I agree with you there. If you think there's any probability that you will be bailed out, it's going to distort your
Correct.
decision.
So, is your argument then that was relatively unimportant?
No. My argument is it can't explain why people who weren't generating these things and weren't going to be bailed out by us, investors in Norway, whatever. Why were they buying them?
Well, I'm happy to admit that some people just made a mistake.
After the fact.
Yeah, after the fact. Ex ante, it's certainly they didn't think they were throwing away their money.
No, right.
And a lot of those people making those investments around the world, we bailed them out too, right? The European banks got some of the benefits of our...
Yeah, because they were mixed into the same... They were mixed into the same pile that involved our own investment banks, mostly investment banks, not actually banks.
Correct. Oh, there's a little, yeah.
And so they got bailed out in the process. So if they were holding CDSs that were issued by AIG, they got bailed out.
Correct. And many of them were, although I think Goldman was the number 2 holder of those.
Yeah.
The first was, I can't remember, it was a foreign bank. It was either French or German. So you have publicly said that was a mistake. Certainly those bailouts. We should have let them fail.
Yeah.
And what's your?
It's irrelevant because there's no political regime that will let that happen.
Correct. But let's just imagine. Let's live in a fantasy world for 30 or 40 seconds.
Right.
Suppose on March of 2008. Ben Bernanke and Hank Paulson and the others who got together to talk about the impending bankruptcy of Bear Stearns had just let them go, had let them declare bankrupt. They would have opened for business Monday morning without any without enough cash to cover their positions. They would have had to tell their creditors that, sorry, I can't honor the promise I made to you the other day or the other month.
Right.
And you won't be getting the payment you anticipated. The justification for the intervention was that if we had let that happen, there would have been an enormous crisis. Credit markets would have frozen up, and we would have had a worldwide depression.
I don't know about the last part. See, that's what we'll never know. The issue is, how long would it take to straighten things out? And I think it's really overrated that it would take a large amount of time. So banks fail all the time, and the FDIC goes in and just kind of draws a line in the sand about who's going to get paid and who isn't, and then the stuff is just distributed, put up for sale, and everything goes on. I don't know how long it would take to solve a multiple failure problem. We'll never know.
Well, the Lehman Brothers bankruptcy is still in process, which is now over 3 years old. So one argument would be, I mean, this was the argument made at the time. Like you, I'm skeptical about it, but it has some legitimacy. It's that, well, bankruptcy is complicated enough as it is. When it's a large investment bank with international creditors like Bear or Lehman, it would take a long, long time. In the meanwhile, everybody would be thrown into turmoil, blah, 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 blah.
Right.
Do you think there's anything to that?
It's possible, but what's happened in the Lehman cases is that it's held up by multiple jurisdictions. So you have to settle with the British debt holders and all the debt holders.
Japanese, Korean.
Or all have their own set of what happens in a bankruptcy, laws about what happens in a bankruptcy. And that's, I think, what they've been fighting over for 3 years. It's pretty clear what assets are there, I think.
But isn't that an argument for justifying what Bernanke did and Paulson did?
Well, I don't know, because who knows what would have been done if all of them went down.
Well, the argument was it'd be chaos.
The problem really is that the investment banks weren't subject to the same disposition rules that would face an ordinary commercial bank. They're not subject to the FDIC.
Correct.
And that the FDIC basically can come in and arbitrarily do it. That's what you buy into when you sign up for it.
Correct.
Whereas for the investment banks, they're not really banks, and they're not subject to those rules. Now, the ongoing problem is that you haven't killed their incentive to finance themselves the way they always have.
Correct. Well, I guess, my claim is that part of the problem is that we gave a regulatory advantage to AAA-rated stuff, which allowed very large and different amounts of leverage compared to other stuff. That gave an incentive to these folks to find more AAA. I mean, the amount of AAA is essentially, until recently, there's just not enough of it to go around if that's the most profitable thing you can do, because that's the thing you can leverage. So they found a way to invent more of it. And that included, not just the things we've been talking about, but European sovereign debt. Hey, that's safe. Let's leverage that too. So once we said, this is the stuff that you can make scads of money on because you can leverage it and use other people's money.
You're slipping back again, though.
Because?
You're saying that people will buy this stuff even though it isn't AAA.
Correct.
Why?
Well, that's the puzzle. Is it because they were stupid? Ex ante?
We're talking about the world's most sophisticated institutional investors.
So is the counter argument, the alternative argument just that people just made a mistake?
After the fact, definitely.
Right.
Whether it was a mistake before the fact, that involves estimating the probabilities of extreme tail events, which, as you know, is very difficult.
Yeah. So where does that leave us?
It leaves us
storytelling, of course. Good storytelling.
Storytelling, right? Which is very entertaining, but not convincing.
Not so helpful.
I don't find it convincing.
Before I forget, I was going to ask you, I don't want to miss this chance to ask you this. Does your research inform your own personal portfolio decisions?
Sure.
And has it over time?
Oh, sure, always.
Has it changed over time?
Well, I'm not as young as I used to be. So.
That's part of the theory, too.
Right. So my portfolio has become somewhat more conservative, but I'm also a stockholder in an investment management company, so that part of it's very unconservative.
Yeah, it's true. Recently, a related question to what we were just talking about before that, recently the government published the transcripts of the Federal Reserve deliberations in 2006. Mm-hmm. And I don't know if you've looked at that.
No.
Well, one of the most obvious things you learn from reading those transcripts is, well, first of all, there's a huge amount. This is 15 really smart people. Again, talking about savviness. 15 very savvy, smart people. Their job is to try to understand what might happen next that could be dangerous. And in 2006, we were on the edge of certainly a collapse in the housing market. And as you argue, maybe just a general problem coming that would be unforeseeable. But what was interesting is that they made the same mistake that I made at the time, and I heard lots of other people much smarter than I am make the same mistake. They said, well, it's true that there could be a housing price fall. It's been going up a lot for a long time. But the housing market's a small part of especially subprime's a small part of the overall housing market. Housing's a small part of the overall investment market. So if there is this problem, if this does occur, it's not going to be much of a consequence, and we don't have to worry about it. Now, one of the things I think that was mistaken for me, as someone who's not very well versed in finance, and I think most economists are not very well versed in finance, is that we did not understand the role that leverage would play if asset prices fell by a relatively small amount. Do you think that has been a lesson that some people have learned from this crisis? And should we learn that lesson? Because I've heard you.
I don't know. So leverage will put some people out of business.
Correct.
So what's the problem?
Well, the problem is that if lots of people go out of business at the same time, it allegedly has a multiplier effect. Hate to use that phrase, but that there's some credit market contagion, systemic risk, et.cetera.
That's a word I don't think existed 20 years ago. But
which one?
Systemic.
Yeah. But wouldn't you argue? Let's go back to our mutual friend Milton. Certainly, Milton would argue that the contraction of the money supply at the onset of the Great Depression, precipitated by bank failures, was something that the Federal Reserve should have paid attention to.
What could they do?
They should have injected liquidity into the system.
Well, but if you have massive free reserves, what's that going to do?
Yeah, that's a problem. Well, again, I wish Milton were here. I'm mystified. I'm mystified by that whole by monetary policy generally, as anyone who's listened to these.
Well, I am too. I mean, I've heard in the podcast of this program that I've listened to, I've heard everybody talk about the Fed controlling interest rates. It's always escaped me how they can do that.
Yeah, I'm mystified by it myself.
But I'm in finance, so you have an excuse.
Now, it's when I interviewed Milton in 2006, and I asked him why there had been a change in public discussion, at least, of what the Fed does, from changing the money supply to instead manipulating interest rates, right? His answer was, well, that's what they say, but that's not what they do. They like to say they manipulate interest rates because it makes them feel powerful. All they really do is change the monetary the base. Yeah. And in fact, he said, if you look at M2, that's the thing to look at.
Well, that's the thing to look at if you want to know what's happening to business activity, but it's not something you can do anything about.
Yeah, that's. I'm with you there. Do you have any? While we're on that subject, do you have any thoughts on why the Fed's paying interest on reserves?
Oh, absolutely.
Why?
Because they know that if there's an opportunity cost from these massive reserves that they've injected into the system, we're going to have a hyperinflation.
So what's the point of injecting the reserves if you're going to keep them in the system?
Exactly.
So what's the answer?
The answer is, this is just posturing. So what's actually happened? that debt is now almost fully interest-bearing, the reserves that they've injected. So they've actually made the problem of controlling inflation more difficult. Controlling inflation when they didn't pay any interest focused on the base. So cash plus reserves. But now the reserves are interest-bearing, so they play no role in inflation. It all comes to cash. All comes to currency. And that's a kind of, currency and reserves are still freely interchangeable. That's what the Federal Reserve is all about. So I think they've lost it. Now what happened? They went and bought bonds, long maturity bonds, and issued short maturity bonds. It's nothing. They didn't do anything.
So why? But they're smart people.
Right.
Ben Bernanke's not a fool.
No, I know.
If you could get him alone in a quiet place with no one else listening, and you could corner him and say, Ben, what were you thinking? What do you think he'd say?
I don't know, but I wouldn't believe it.
Do you want
to? In the sense that, at most, he could have thought he was going to twist the yield curve.
Yeah.
Lower long-term bond rate. But now I'm looking at the international bond market. It's wide open. Even though they're doing big things, they're not that big relative to the size of the market.
Yeah, I am mystified by it as well. I don't have an explanation, but I have a.
Or let me put it differently. So if I look at the evolution of interest rates, is it credible that in the early 80s the Fed wanted the short-term interest rate to be 13 to 14%?
No.
Not really.
You're making the argument that it's endogenous, that they can't control it.
They maybe can tweak it a bit. They can do a lot to inflation expectations. That'll affect interest rates. But otherwise,
this is the.
I'll turn it around. All international banks think they can control interest rates, and at the same time, they agree that international bond markets are open.
Yeah.
Those two things are inconsistent.
Correct. Now, it reminds me of this CNN reporter, credible insight into economic policy. He said macroeconomics, he was talking about macroeconomics generally and fiscal policy, but he could have equally as well been talking about central bank policies. He said politicians who think they can control the economy are like a little kid who's playing a video game. He hasn't put the money in yet, and he's watching the arcade game do all its bangs and bells and whistles and noises, which is an advertisement for the game. And he's pushing the buttons, and he's attributing all the successes on the screen to himself, even though he hasn't put the money in yet, because he misunderstands the underlying process that generates the what he's seeing on the screen.
Right.
There is some truth to that.
There's a lot of truth to it.
Well, let's turn to fiscal policy, which you've written some interesting things on lately. You have been very skeptical of, as have a few others. And by the way, I would add, before we get into this, I should just mention that your view that it's an open question as to whether the crisis was averted, a crisis was averted by these rather remarkable interventions by the Fed and the Treasury Department in the last few years. It's not a mainstream view. Certainly most economists believe that, and I'm with you, but most economists believe that the Fed and the Treasury and the policymakers did a good thing. That they say that's not taking into account the long-term cost. For sure, and that would be true of most of these interventions. I always find it remarkable that the auto bailout was a success, quote, because very few people lost their jobs, as if that's the only effect we would ever want to look at. Well, the long-term effects of that are horrendous. Yeah, and it's not clear that they saved very many jobs either. But yeah, clearly they changed the incentives. Not just change the incentives, they changed the ordering of precedents and contracts. That's something that's really dangerous. Yeah, they abrogated the rule of law. It's very depressing. But on this issue of fiscal stimulus, most economists most economists believe it's a good thing. It works. We are in the minority who suggest that maybe it isn't effective. And you recently wrote a piece suggesting, I would argue, that suggests it's, quote, never effective unless it's well spent. And I would contrast that with the Keynesian view, which I heard come out of Joe Stiglitz's mouth personally, because people always think this can't be what they really believe. But I heard him actually say, it doesn't matter what you spend the money on, it's all stimulus. And you are very much on the other side. So explain why. Well, when he says it doesn't matter what you spend the money on, I think he's
thinks there are multiple choices that would all be good. He doesn't think that if you just wash it down the sink, that's good.
Oh, no. He said when pressed, he was asked if you pay people to dig ditches and fill them back in, would that stimulate the economy? And he said yes, but it's not as good as doing something productive. I can't explain it. It's a mystery to me.
It's a mystery to me,
yeah,
too.
but he's not on the show right now. I wish he were. I'll try to get him down the road. But in your view, just talk about what you think the effectiveness of stimulus is and why you're skeptical.
Well, this is a case where you can't be sure, because if you look at the empirical evidence, it basically allows you to say anything you want, because the estimates of the effects of stimulus are subject to so much uncertainty. So I think if I interpreted Christina Romer's stuff properly, she and her husband stuff, what it says is that the only thing that clearly gets a pretty good statistical support is permanent tax deduction. And then the other stuff is you just can't say anything about. So I think that's probably I'm an empiricist in the end, so I have to say you just don't know. I mean, I have my position that I think it's a waste of money, because it'll all be wasted, and eventually you have to finance it. You have to finance it now, which means eventually you have to pay back future generations have to pay back the resources that were spent now on these things that are mostly useless, maybe. But the evidence doesn't let you say. So it's possible for Stiglitz to say one thing, it's possible for you and I to say something entirely different, and neither one can point to the evidence.
Yeah, I don't view it as a very scientific enterprise. I view it as essentially ideology being wrapped up in scientific looking statistical estimation. It seems to me it's too much noise.
Well, I don't agree with what you said when you started. I don't think most economists do think it works. Or maybe I'm in the wrong cocoon,
Yeah, you need to get out more, Gene, I think.
Right.
Although I'm in a different cocoon over here on the East Coast. I'm the only cocoon I'm a George Mason, so we have the same, and occasionally I'm in the Stanford cocoon. So we're in just happened to talk about the three places where I say there's an overwhelming majority that is skeptical. But outside of those three, it's pretty much, I think, the other way.
Yeah. Well, Bob Barrow, he's a skeptic.
Yep, lonely voice
Right.
in that enclave.
Well, I think, his name is skipping me. He's Barrow's famous macroeconomist at Harvard, the younger fellow.
Alicina.
No. He was...
Because he's a skeptic,
Bush's,
too.
Council of Economic Advisors.
Oh, Mankiw.
I'm sorry. You never forget that name. But he's skeptical, but what he says is, once you get into politics, you become a Keynesian. But that's just, political pressure is just enormous. I think that's right.
It's a terrible view of our intellectual opponents, though, right? It's not very nice. We don't like it when they attribute our views to, say, being friends of business, which I find repugnant. So it seems embarrassing to suggest that they hold their views because they like being powerful.
Yeah.
I think there's some truth to it, but it's not very nice. You want to hold that view?
Hold which view?
That they're...
I don't know. I don't think economists are different from other people. They all like to have their views accepted by everybody else, no matter what their views are.
Yeah, we're prone to incentives. There's no doubt about that.
I've had to have a tough skin for a long time because I believe in efficient markets.
You get a lot of flack.
Right.
Let's go back to that for a minute.
Okay.
To finance. We'll get back. Well, let's leave macro. Although I will put a link up to the recent essay you wrote on stimulus where you make it, I would call it a theoretical argument against stimulus, not an empirical argument.
There's no data, right?
And I think basically you're using, and it's interesting how the Chicago School has been pushing this. You're using what we would call accounting identities.
Right.
The money's got to come from somewhere. I expressed it as the resources have to come from somewhere.
Anything, right? Well, I mean, that's the right way to say it, actually.
And so I don't understand where the free lunch comes from.
There is no free lunch.
But the claim, well, the counterpoint is that, well, there's a free lunch because there are all these unused resources laying around, and then it's a question. And Milton said this also: how much of the stimulus goes towards the unused so-called?
That's the problem of implementation, which is horrendous.
Yeah,
it's the same problem in regulation. Implementation is always a killer.
But let's go back to finance.
Okay.
There's been a big trend in recent years toward what is called behavioral finance.
Right.
What's your assessment of that?
Well, I think the behavioral people are very good at describing microeconomic behavior, the behavior of individuals that doesn't seem quite rational. And I think they're very good at that. The jump from there to markets is much more shaky.
Explain.
Now, there are two types of behavioral economists. There are guys like my friend and colleague Richard Thaler, who are, soundly based in psychology. His degree is in economics, but he's become a psychologist, basically, and he's coming from the research in psychology. Now, there are other behavioral finance people who are basically what I call anomaly chasers.
Yeah.
What they're doing is they're scouring the data for things that look like market inefficiency, and they classify that as behavioral finance. But to me, it's just data dredging.
Well, they don't tell you about the times they can't find the anomaly.
Exactly.
So,
all economic research involves a multiple comparisons problem that never gets stated.
A multiple what?
The fact that the data has been used by so many other people, and the people using it now use it in so many different ways that they don't report, that you have no real basis to evaluate. You have no real statistical basis to come to a conclusion.
Yeah, my view is you should video your keyboard so we could see your keystrokes, right? And then we'd see what you threw out, the dishes that didn't come out of the kitchen because you didn't like the way they tasted or looked.
Right. Well, I've had people say to me that the people who do this anomaly stuff, when they come and give a paper, and I'll say, "Did you do this, that, or the other thing?" And they'll say, "Yes." And I say, "Why don't you report it?" And they say, "It wasn't interesting."
Yeah, it wasn't interesting, yeah. It's not publishable either.
Well, that's the problem, that there's a culling process in the publication process as well. Only the eye-catching stuff makes it through.
So we started off this conversation talking about efficient markets, and we haven't talked about a zillion other things that you've studied or that are important in the field of finance. So I want to we've got about 8 or so minutes.
Okay.
One question I'd like to hear you talk about is the issue of a non-specialist. Let's say I'm just a smart, everyday person and I want to be educated out in the world. What are the lessons for me that finance has learned that are important there's obviously a lot of findings, some of which have stood up, some of which had to be modified over time. What do you think we've learned in finance over the last 50 years as it's become more empirical that an educated person should be able to understand and use?
Well, I'm obviously going to be biased, but I think all of the stuff on efficient markets would qualify. I think there's been a lot of stuff in the corporate area, corporate governance and all of that stuff. That's a huge field in the corporate area that has penetrated to the practical level. Options pricing is, the Black-Scholes options pricing paper, in my view, is the most important paper in economics of this century.
Why?
Because every academic, every economist, whether they go into finance or not, learns that paper, and it created an industry in the financial, in the applied financial domain. What else can claim that? I think we've learned a lot about risk and return. Some of it is intuitive. I mean, no bonds are less risky than stocks for the most part. But there's a lot of stuff on which stocks are more or less more risky or less risky. A lot of stuff on international markets. Now, what should an ordinary intelligent person know? That's a harder question.
Well, let me
turn it over. what should an ordinary intelligent person know about price theory?
Yeah. Well, I have some thoughts on that. You probably do too.
Yeah. Well, I mean, it's difficult. So I know lots of very intelligent business people who need some knowledge of what's going on in finance, but not an awful lot, because that's not a big part of their business, you know?
Correct. I guess I would worry about what people think they know that isn't so, and the things that they don't know that they should know.
Oh, that happens to me all the time. I'll be playing golf with somebody, and they'll ask me what I do, and I tell them I teach finance, and they say, oh my goodness, I don't know anything about finance. And then they give me a lesson in finance.
What do they usually say?
Well, they tell me all about their smart investments.
Yeah. Do you smile and just take another strike at the ball? Or
I do, right.
Do you say anything back?
No, I don't, but I avoid them in the future.
It is one of the fascinating things about our profession, and it must be true for many other professions as well, but everybody's an expert. So it's your 50 years of empirical, incredible in the trenches work is meaningless because that guy had a good month.
Right.
He doesn't think he has much to learn from you.
Indeed. Especially if he's making a lot of money.
Right, he is, right, sure. He's doing great. He knows. But it is I was really thinking more of practitioners and experts, not of lay people. So I assume there are some things that we think we know in finance that may turn out not to be so.
Oh, absolutely.
And that has been a problem. I guess I'm thinking about a macro, which I know a little bit more about, right? We're thinking about the great moderation and the comfort that many people had that we had mastered the business cycle, and that turned out not to be true.
Right.
So I assume there's some aspects of finance that may
absolutely. I mean, it's what I say to my students is, I'm showing you the stuff that people have done in the last 30 years, but in 20 years, it may all be irrelevant. So the best I can do is to train you about how to think about these things so that you can absorb stuff that comes along in the future that may overturn what's there now. That's what makes this profession fun, though, I think. The fact that stuff can get overturned. We're all decided, what fun would it be? Yeah,
what are some of the, well, of course, if we only have the illusion of understanding, or what Hayek called the pretense of knowledge, where we could be doing some dangerous and stupid things under the guise of thinking we're making progress.
Right.
So you do have to be careful. Where do you think there are in the near future and maybe the longer future, where do you think research in finance is going?
Oh, gee, I've never been able to answer that question. That's part of the fun of it. You just don't know. I would not have been able to predict 30 years ago the stuff that evolved in those intervening 30 years. No way. So that's
it's kind of a random walk.
Well, I don't even think it pays to think about it very much.
Uh-huh.
Because what happens is there's so much serendipity in what happens in research. So my best stuff has always been, I didn't start thinking about writing a great paper. I started thinking about a little problem that just kept working in circles into a bigger problem, or had offshoots that were related. So I've beaten many topics to death. And as a consequence, I've got a lot of recognition for developing the thing, and for what started as a little thing developing into something much bigger. So that's not a predictable process. So you can start lots of little things that end up as nothing. Or a student comes to me, a PhD student, and says, I want to write a great thesis. I said, you can't do that. I mean, you can't start out to do that. You have to pick a problem and hope it works out into something that will get you a job.
Yeah.
And hopefully a good one. But you can't, if you start saying, I want to come up with a great topic, you won't come up with anything.
Well, you recently wrote a very nice essay. We'll put a link up to it called My Life in Finance that gives an overview of your some of your contributions and some of your thinking along the way and how those little problems got started. You start by talking about your thesis topic,
right,
where you had 5 ideas, and Merton Miller said 4 of them weren't very good.
Right.
Were any of those? Did you ever go back to any of those 4?
No, actually. Merton was incredible. He had a great eye for stuff that would work and wouldn't work. I went to Belgium for 2 years to teach. And I came back and showed him the stuff I had been working on, and I think he discarded like 8 out of 10 things. he was right on all of them.
Yeah, well, such is life.
Right. Well, it taught me that nobody can work in a vacuum. You really need colleagues around you to really enrich your work. I mean, you get credit for it in the end, but there's a lot of inputs from other people that go into it in the meantime.
Well, thanks for sharing some of your wisdom on EconTalk.
Okay, my pleasure.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.